Quick question. Do you own a gold ETF? If yes, great choice by the way. But here's something most investors don't know yet. The gold ETF you're holding today may not be backed by physical gold the same way it used to be. Now, before you panic, let me explain exactly what's changed, why it happened, and most importantly, what it means for you. Stay with us. This one's important. So let's start from the beginning. A gold ETF, exchange traded fund, has always been one of the simplest ways for Indian investors to buy gold. No locker, no making charges, no fear of theft. You buy units on the stock exchange and each unit represents a certain amount of physical gold held by the fund. Clean, simple, transparent. That's why millions of investors love it. Now here's what's changed. In June 2024, SEBI, India's market regulator, allowed gold ETFs to count something called ETCDs, or exchange-traded commodity derivatives, basically gold futures contracts, as part of their mandatory gold allocation. HDFC Gold ETF became the first fund house to actually act on this, through an addendum dated 15 March 2026. So what does this mean in plain English? It means your gold ETF now has the option to hold a paper contract that tracks gold instead of only the physical metal sitting in a vault. Now, we know what all you're thinking. Should one be worried? Here's our honest take. And this is also something our CEO Mr. Ajay Kumar Yadav has shared when ET Wealth covered this topic recently. Giving fund managers the option to use gold futures is really about handling practical situations better. Think about it. What happens if there's a sudden surge of inflows into a gold ETF and the fund needs to buy physical gold quickly? Sometimes, the physical market can be slow or temporarily unavailable. In that situation, gold futures act as a backstop, a placeholder. The fund buys the futures, stays aligned with gold prices, and then converts back to physical gold when the market normalizes. So from an investor standpoint, the product you are buying is still the same. It's a liquidity mechanism, not a structural change. And here's proof. HDFC Gold ETF's latest portfolio held 98.65% in physical gold bars. Futures exposure is capped to a maximum of 50% of NAV, and that's a worst-case limit, not a target. Now, at Wise Finserv, we always give you the full picture, not just a positive spin. So let me quickly walk you through both sides. What works in your favor? 1. It acts as a backstop during physical gold supply disruptions. The fund stays aligned with gold prices even when physical buying isn't possible. 2. It reduces something called tracking error. That's the gap between your ETF's performance and actual gold prices. Futures help close that gap. 3. And this is important, once normal market conditions return, the futures positions are unwound and the fund goes back to holding physical gold. Physical gold always remains the core. Now, what should one watch out for? First, futures are not the same as owning physical gold. In certain market conditions, futures prices can deviate from spot gold prices. Second, futures contracts need to be rolled over periodically. That adds a small cost which can marginally affect your returns over time. Third, if you decide to exit your gold ETF during a period where futures are being used, there may be capital gains tax implications depending on your holding period. So, stay informed, not alarmed. So let me quickly summarize what we covered today. Gold ETFs are evolving. SEBI's new provision allows them to use gold futures as a backstop mechanism, not as a replacement for physical gold. For most long-term investors, this doesn't change the core value proposition. Your gold ETF still tracks gold, still reflects gold prices, and is still the simplest way to get gold exposure without worrying about physical storage. But, as always, it pays to stay aware of what's inside your investment. At Wise Finserv, this is exactly what we do. We break down complex financial developments into clear, simple insights so you can make smarter decisions with your money. If you found this useful, hit like, share this with a friend who owns a gold ETF, and subscribe so you don't miss our next video. And if you have questions, drop them in the comments below. We will read every single one. Until next time, invest wisely.